Welcome to the deep dive. We've got quite a list today, 22 U.S. stock tickers. But the real story isn't just the raw data, is it? It feels like it's more about, well, control.
Exactly. We're definitely past that first wave of Q3 earnings announcements. Now it's about the reaction. And you see these two clear patterns emerging.
Which are?
Well, first there's panic, real panic when future guidance looks weak. But then you see these decisive corporate moves, strategic capital actions, companies taking control.
Ah, okay, so that's the tension. Who's controlling their own story and who's getting pushed around by analyst forecasts?
Precisely. That's the lens we need today.
Okay, so we've sifted through everything, grouped it into four main areas to make sense of it all. Let's just jump right in.
Sounds good. Let's start with digital health and fintech, that post-earnings scorecard.
Okay, Affirm, AFRM. This seems like a good example of resilience, right? Their Q3 earnings were good, beat expectations, but the stock dropped at first.
It did, yeah, which was, a bit confusing initially. But the narrative is shifting now. Analysts are catching up. Well, the biggest piece of news just hit, maybe 11 hours ago. A sinking alpha analysis. They upgraded their view, calling it, get this, a leader is born.
Wow. That's quite a statement.
It really is. It feels like a strong confirmation looking past that initial wobble and seeing the underlying strengths from Q3.
Okay, makes sense. Now, Hims&Hers, Hims. Q3 looked fantastic on paper, revenue up nearly 50%, adjusted EBITDA up even more.
Stellar numbers, absolutely. But the stocks movement, the buzz, it's all about one thing right now.
The GLP-1s.
The GLP-1 catalyst,
Yeah.
Exactly. Everyone's focused on their talks with Novo Nordisk,
Yeah.
Potentially offering Wegovy, both the oral and injectable forms, on their platform.
That's huge potential, obviously. But hang on, if the growth story is that strong, why the volatility? I mean, the PE is what, over 160?
Yeah, it's sky high.
And short interest is still really elevated, like 35%. A PE like that prices in, well, perfection for years. What's stopping it from just collapsing under that valuation?
That's the crucial question, isn't it? The valuation is definitely stretched. And that high short interest, it shows there's real skepticism about whether they can sustain this GLP-1 momentum. It's competitive out there.
So they need that segment to become massive, like yesterday.
Pretty much. Those valuation concerns are real, creating this sort of resistance despite the great earnings report.
Right. Now let's flip to the downside of forecasting. The guidance gap, you called it, Teladoc, TDOC, and Doximity, DOCS.
These two are perfect examples of the market punishing future uncertainty. For Teladoc, their loss per share got wider,
Why was that?
mostly driven by BetterHelp, their mental health division. It's just not performing well.
Even though international did okay?
International revenue is positive, yeah. But the market's laser-focused on the struggles in the core U.S. business, especially BetterHelp. The stock's down, almost 9% since late October. The worry is sticking.
Okay. And Doximity, they actually beat their numbers for the last quarter.
They did. DOCS had solid Q2 results. Revenue up 23%, EPS up 50%. Good numbers.
But the stock still tanked. Why?
Guidance. Simple as that. Their forecast for Q3, the next quarter, just disappointed. Came in slightly below what the market expected.
Wow. So the market cared more about that slight miss on the forecast than the solid quarter they just delivered.
Way more sensitive to the future outlook right now, it seems. Even a small crack in the forecast gets punished.
Okay, so digital health, fintech, judged harshly on the future. Let's switch gears then. Prop tech. You mentioned the story. There is less about guidance, more about external forces and big corporate moves.
Yeah, exactly. And if you look at the crypto-linked fintechs first, like Coinbase, Sequoia, Robinhood, Block, Skew, their recent moves aren't really about them.
What do you mean?
Well, none of them had major company-specific news or filings in the last day or two. Their price action is basically being dictated by the wider crypto market.
Bitcoin falling below that key moving average.
Yep, the 200-day moving average. That's putting this systemic pressure on all three of those stocks. It's a macro headwind for them right now.
Okay, but then there's Opendoor. That was an external pressure. That was a massive internal decision, right? A huge capital raise.
Huge and really decisive. This is a perfect example of a company trying to take control, overriding maybe the day-to-day earnings noise. They filed some critical SEC docs, 8Ks, 424B5s, basically signaling we need cash and we're getting it.
So what exactly did they do, and, what's the impact for existing shareholders?
Two main things. First, they gave out warrants to current common shareholders, sort of like a dividend.
Okay.
But the much bigger piece. They agreed to issue about 180 million new shares of common stock at $6.56 a share. It's a registered direct offering to specific buyers.
180 million shares. That's a lot.
It's a very large capital raise.
Mhm.
It clearly needed the funds, a lifeline perhaps. But yeah, issuing that many shares brings up the D word, dilution.
Right. Risk for existing holders and necessary maybe, but potentially costly for them.
Exactly. It's a move for long-term survival, but it comes at a short-term price for current investors.
Okay. What about the more established prop tech players? News Corp.
News Corp, NWS, pretty straightforward. They just reconfirmed their ongoing $1 billion stock buyback program is still active. Pure shareholder value support there.
Standard playbook. And CoStar. CSGP.
CoStar is actually pretty interesting today. Their main news is that they're scheduled to present at the KBW FinTech conference, like right now.
So investors will be watching that closely.
For sure, especially since CoStar also recently put out a report kind of lowering their short-term forecast for the multifamily market. People will want updates on that.
Good point. And just a quick clarification on Compass, COMP. There was some noise around similar tickers, right?
Yeah, Kodiak had a 10Q delay. CPGL got an upgrade.
Yeah.
Easy to get confused.
But the actual Compass Inc. ticker, COMP.
Nothing major. No significant news or filings for them in the last day or two. Always double-check those tickers.
Good reminder. Okay, let's pivot from property to the consumer. We see that tension again, right? Growth versus valuation, especially with Celsius.
Oh, Celsius CELH is a fantastic case study in that exact tension. The stock dropped quite a bit after earnings, right?
Yeah, it did.
So what did the company do? Announced a big corporate control move just 2 days ago. A $300 million stock buyback. Actively stepping in to support the price.
Okay, that sounds positive, aggressive even. But the valuation debate is still raging, isn't it? Why is the market so worried if they're growing and buying back stock?
Well, the analysis points to a couple of things. One is just general investor worry about costs and maybe some nervousness about changes in their distribution deal with PepsiCo adds a bit of execution risk, you know. But the real core of it, it's that price to sales ratio. CELH trades at like 5.4 times sales.
And the average beverage company
is around 2.1 times.
Yeah.
So the market's basically asking, is Celsius's growth rate really worth almost 3 times the industry average premium? That's the debate.
Got it. Okay, different kind of beverage company. Dutch Bros, BROS. Seems like analysts are pretty excited after their Q3. What's the secret sauce there?
It's really about the details in their operations. The positive reports are focusing on strong comparable store sales, comps.
Okay, standard metric.
But here's the interesting bit. The stores that introduce hot food, they saw an extra 4% jump in comps.
So expanding beyond just coffee is actually working, measurably.
Exactly. It shows the strategy's paying off. And overall, Q3 revenue grew 25%, EBITDA up 37%.
Yeah.
It really reinforces the idea that their plan to open more stores is on track and accelerating. Solid buy narrative building there.
And a couple of quick retail indicators. Wayfair, W?
Yeah, Wayfair hit a 52-week high just maybe 9 hours ago, around $109. That suggests the market likes the follow-through on their earlier cost-cutting efforts. It seems to be working.
Okay. And On Holding, the shoe company, ON?
Truist Securities took another look. They kept their buy rating, which is positive, but they did trim the price target just a bit, down to $60.
So still confident long-term, but maybe pulling back on the short-term expectations slightly.
That's how it reads, yeah. Tempering expectations a little, but still fundamentally positive.
All right, let's move into our final segment, wrapping up with software, streaming, and some of those longer-term stories coming out of Q3.
Okay, starting with Netflix, nflx. The really big news was obviously that 10-for-1 stock split back in late October.
Right, and the market's still digesting that.
Yeah, the analysis and the structural impact of that split are still making headlines. It's keeping the stock in focus.
So what did you see specifically in the last, say, 24 hours? Anything concrete?
We picked up on some noteworthy ETF capital inflows related to Netflix and also significant options trading activity.
Meaning?
It suggests the bigger players, institutions, maybe hedge funds, are still actively adjusting their positions and strategies because of that split. It's not just a one-day event. It has follow-on effects.
Got it. And then two others that seem to be generating interesting long-term signals, Duolingo, DUOL, and Lemonade, LMND.
Yeah, for Lemonade, LMND, the news basically a big vote of confidence. An investment firm, X Square Capital, they reportedly doubled their stake in the company.
Doubled down.
Exactly. That's usually not a short-term flip. That signals they see real long-term value there. A positive sign from a sophisticated player.
Okay. And Duolingo, it dipped after earnings, but now the narrative is shifting.
It really is. The pullback is now being framed by some analysts as basically a bargain, A buy opportunity. One report literally called it a magnificent artificial intelligence stock. The argument is that maybe it was just too expensive 6 months ago, and this dip, it's the market giving you a better entry point into what they see as a strong long-term AI growth story.
Interesting framing. Okay, before we wrap up, we had a bunch of other tickers on our list. FUBO, RKU, CVNA, INMD, OTLY, BRBR. Any common thread there?
The common thread is quiet.
Holding pattern.
Yeah, pretty much holding their breath. We checked. And FuboTV, Roku, Carvana, InMode, Oatly, and Brinker Group all had a really quiet last 24-48 hours. No major new SEC filings, no big company-specific headlines.
So they're just letting the market digest those early November Q3 results.
Exactly, waiting for the dust to settle, it seems. Hashtag check outro. So, okay, stepping back. What does this all tell us across these 22 companies? That central tension we talked about, it's just really clear. The market is hyper-focused, maybe even panicking, about weak guidance. Look at Doximity or Teladoc's BetterHelp segment. Even if current numbers are decent, weak guidance gets punished hard.
Right. But on the flip side,
where you see volatility, companies are fighting back with corporate control. Big strategic moves, think Celsius's massive buyback or Opendoor's huge capital raise. They're actively trying to manage the narrative and their future.
so hopefully this deep dive has cut through some of that noise for you, saved you maybe days of digging through filings and reports. It's really a snapshot of how the market is reacting right now after Q3.
Yeah, and maybe here's a final thought for you to chew on as you watch the markets. We saw analysts calling stocks like Duolingo buy opportunities after they pulled back on earnings.
Right. The dip is the opportunity.
So the question is the market just being overly sensitive to short-term guidance hiccups right now, basically creating bargains? Or are those analysts seeing the real limits of post-pandemic growth, meaning these dips are actually justified warnings? Something to definitely mull over this week.